$20 is $20, Jack.
That's true, Don.
Dear listener, we are laughing because Aaron packed his fiance's t-shirt today, and it felt like the tight t-shirt competition that Aaron was striving for. Correct?
Well, I often get mocked for my t-shirt wearing anyway, but this was really bad. This is not the shirt, by the way. I have changed since getting home. But I
You
left
said
home
even your armpit hair was sticking out the arm.
The sleeves were basically to here. So not only did I have a meeting, I actually had to also give a talk to some startups and others, and there was hair sticking out of my not one of my yes.
Oh dear. Hi everyone. Welcome to Tribe Talking this week.
Afternoon. Hot as hell. Summer's back.
Yeah, 33 or something today I heard in Brisbane, Vegas. And I think yesterday Sydney had 35 and we're like 20 days into spring.
And you had what, 11?
Yeah.
It was raining. It was raining yesterday in place.
Yeah, raining and woolly and howling wind and yeah.
Double digits though.
This could be when Jack goes back.
I know. It was sunny on the weekend and then I arrived yesterday and it's raining and I'm sitting by the heater.
So you brought it.
Yeah, I know. And I'm leaving sunny Queensland. No luck.
Well, what can we do except maybe install an air conditioner, Don?
Yeah. So I've just remembered my mower is at the needs to be picked up too. So this has been a very fruitful session already. I better write that down on my to-do list. Yellow mower.
Excellent. Yellow mower. You've got so many. You have to delineate by colour.
I don't want to be that guy, and I don't want to be a total wanker about it, but I have a red one, a yellow one, a blue one, and a green one.
Different ride-on mowers.
Yes,
Plus
others and tractors. And he has pretty much a shed for each.
Okay, Rockefeller. Sure. I'll take your word for it.
Some people buy stamps and waste their lives. I'm a sort of hydrocarbon cutting grass kind of guy.
Yep.
Mm-hmm.
Great. Doing your bit for net zero.
I got solar.
For the lawnmowers?
The lighting in the sheds.
Yeah.
Awesome. All right. Shall we jump into some news?
Let's do it.
Absolutely.
All right. I thought maybe the Instacart IPO might be a good place to start. So this week, Instacart finally launched their IPO Wednesday US time. And by all accounts, it was extremely successful. Shares ended up rose by 43% during the day, closed out at 12% above the listing price. All's well that ends well on the IPO front for Instacart, although the listing price was quite a discount to the valuation that the company received privately in 2021.
Yeah.
So I think at listing, it gave it a valuation of just shy of 10 billion, but they were valued at 39 billion at the last round of capital raising that they did in 2021.
Was it a big round in 21? Is there a lot of people underwater or it was fairly minor?
Actually, I don't know how much was raised in that round, but obviously those who participated in that round are currently underwater.
If you put in a chunk of cash when it was 10 mil and a little bit when it was 39 bill, you're probably still doing all right at 9.9 bill.
Yeah, that's right. And I think the article, which was in the AFR by Nick Bonhady, and I apologise, my dogs are barking right outside my office right now, actually said that meant investors have recorded some big losses. And while I think those investors who came in at that last round are no doubt underwater, really you're only registering those losses if you've sold into the IPO. And I imagine the ones who were selling into that IPO were the ones that had invested quite a long time ago and supported its growth previously.
Be interesting to see the volume of trading on the first day as well. So did you say, Lane, it went up 40? Yeah, that's quite a significant jump. Ended up still 12% up. But yeah, I'd love to look at that a bit more, see the actual volume and if maybe people were liquidating a bit, some of those initial shareholders.
Yeah, I think I read somewhere else that investors had sold about 300 million into that IPO. Right. But I'm assuming, just based on how these things generally track, that was early investors who had been obviously looking for a point of liquidity for their holding, and obviously an IPO is an opportunity to do that. Some of them, if not all of them, were likely to have been held to an escrow so that it didn't sort of artificially affect the share price and trading in the near term. But the article also said that, and I'm going to try and find the words that were specifically used in it, was venture capital funds depend on public offerings to generate the largest cash returns from their most successful companies, which often become too large or are too ambitious to be acquired by their competitors. I don't agree with that statement, actually. I feel like
that's something else, doesn't it?
Yeah, I think the point the journalist was trying to make was that these really big companies, like the Canvas of the world, it's difficult for them to be acquired. Once you get so big, the universe of acquirers gets vanishingly small. And so IPO does tend to be a favourite option in those specific cases, but they're really rare. Most VC funds don't have a Canva in their portfolio. And there was actually a study done by the University of Colorado a while ago, which looked at companies, I think it was like 45,000 companies over the period of 1984 to 2021. And it followed these companies from the very first check that was written and watched how they tracked. And they found that of the ones they started out tracking, 16% were eventually acquired, but only 2.9% of them actually went through to IPO. So it is the rarer option, and not just recently, over the past several decades, but it is an option for exit, obviously. And so it's great to see that the IPO market might be opening back up in the US, and Australia usually trails the US by 6 to 12 months. So hopefully that's some good early green shoots for Australia as well.
Yeah. And I was trying to find the article. There was an article, you might remember it, Lenny, probably a month ago, that talked about how closed the IPO market was and how this was impacting VC returns. And at the time, we talked about the other pathways to exit and this same kind of discussion. It is really good to see the markets opening, but to that point that the M&A activity, the acquisitions, the other pathways, and increasingly at the moment, we're seeing a lot of secondaries happen in the market as well. And also not forgetting dividends and other means that investors get returns as well. So, I think it's a really good point to pull out of that article is IPO isn't the only strategy or even the key strategy. It's one of many.
And having taken a business onto the ASX, and you grow up when you're young reading the beer list and you have these aspirations to take something public and all of the fanfare that comes with it. But having been through that sort of experience, anytime a founder says to me they want to go public, I first try and find a couch, get them to lie down and tell me all of their... Pardon?
Give them a Bex and a lie down.
Yeah, coke and a smile, and unpack all of the internal mental things that are driving that thing, because the majority of companies should never be listed. Like, it's not an environment that is conducive to a whole lot of stuff. And some of the reasons why founders want to list may not actually be the healthiest reasons. And then they end up in the public markets with a whole lot of scrutiny and energy that goes into all sorts of shit that they don't like. And then they find themselves in a really unhappy place. And then the business suffers, and before you know it, share price suffers, and blah, blah, blah. So anybody that's out there aspiring to the IPO, I always want to try and understand why.
But also the IPO is a moment in time, right? It's the firing gun on an exchange, a public exchange. And so there's this assumption that this is the end for those investors. The reality is most companies, if they're doing well and they're not going through one of these extremes in the market cycle, that share price should track okay over the next few years. And if they're patient and get their timing right, they may still eventually get back to the price that was paid in 2021 or more. Airbnb and DoorDash, I think, listed in 2021 as well. So when Instacart did this last private financing, DoorDash and Airbnb listed right as that pandemic had hit and the demand for those services was so strong. And so they got their timing right in terms of investor interest, but the performance of the companies over the intervening years has meant that I think Airbnb's share price has decreased by 50% and DoorDash is about the same over that period of time. So performance after the IPO is actually really what matters. It's not so much the starting point of the actual IPO.
But as long as you've got it's just that the public markets can sometimes deliver you conditions that are not conducive to what you want to do. So as long as you don't have a business that suffers some of that stuff. And one of my shareholders gave me some advice during some of the challenging times when share price was on the slide. He said, look, stop looking at it. At the end of the day, investors can make their own decision. If they want to be on, they'll buy. If they don't want to be on, they can sell. Don't put so much energy and time into it. And ultimately, Adrian, one of our shareholders and venture partners, you follow his roadmap. He's had a really healthy, sometimes difficult, as he discussed in the podcast with some of the challenges. But there's someone that's managed to handle it really well.
You mentioned, Aaron, secondary market, and we've talked about that previously as a way that VC funds have managed to deliver some exits, I guess, against a backdrop of a closed IPO market and a soft M&A market. But you shared, I think maybe Don shared some data earlier this week, which was out of Carter, which actually showed that there's been a steady decline in the price that's being paid for secondary transactions as well over the last, I think, 12 months. I think it was over 4 quarters or maybe 6 quarters.
Has that come up on the screen or not?
Still
it's loading, but I can talk to it. But what the graph or the chart showed, here we go, is that the differential in price discount paid by a secondary buyer for shares, depending on the class of shares, relative to the last round's price. And you can see how that's just been in steady decline for both ordinary shares and preference shares over the last 6 quarters. And where it's sitting at the moment is that if you're selling preference shares in a secondary transaction, you can expect to see a 30% discount on median for the purchase price. If you're an ordinary shareholder, it's obviously a lot bigger, circa closer to 50%. Now, we might see this turning around too in the next couple of years. And we've talked about this on the podcast previously, but just interesting to see how that's tracked as well against the backdrop of that same period of time that we've been talking about since 2021.
Yeah. And I think one of the things there is when we've had a decline in the market generally in terms of ours, but if money isn't going into growth capital, there's always a wee bit of a discount.
Yeah.
Yep.
Anyway, we will watch eagerly to see whether this kind of positive momentum that exists around the US IPO market in tech companies persists, and because I think it could possibly be injured pretty easily by a poor outcome. So we'll see what the next few are like, and then we'll see what will be the kind of first cab off the rank in Australia too, I think in probably 6 or so months.
Yeah.
Cool. The other thing that was in the news, there was Adir Schiffman, who some might know is the chair of Catapult, has been in the news a couple of times this week. So it might be worth talking about the one for a dispute that he's in the middle of, and one where he actually wrote an editorial in the AFR about another transaction and the consequence of timing.
So before reading this one, I confess I didn't know anything about sleeping duck, so I had to look up what sleeping duck was, and I totally misread the headline when I saw the articles. Mattress company.
Been taking sleeping duck to court.
Yeah, exactly. Is this a new strategy?
You had a different conjuring in your head.
I did. Like, is this some type of new legal strategy I didn't know. That was my ignorance coming in. Since learned it was a mattress company that he invested in as an angel investor back in 2017, and now in dispute with over basically being pushed out of that position. But probably really useful to talk about this in the context, like what can founders learn from it, I think.
Oh, absolutely. Yeah, we don't know the details of the dispute in any meaningful way, except what has been reported in the article, which was that you had invested $100,000 initially as an angel investor, but also had an agreement for equity in exchange for advice, introductions to networks, strategy, assistance, and help with their capital raising. And now what he has accused the company of, or the founders and other directors of, is shareholder oppression. And I don't know if this is a term that our listeners have heard before, but it's a thing, right? It's not a kind of a throwaway line. Shareholder oppression is a a legal definition. It's where you unfairly prejudice or discriminate against some minority shareholders and I guess directors always have to try and weigh up what's in the best interest of the company, but also what is fair and reasonable for the shareholder group as a whole, as opposed to one particular shareholder group. And the minority shareholders are a vulnerable group because they often don't have a lot of say over decisions that get made and can be sometimes unfairly squeezed out of things. So it's a concept that directors and founders and companies need to be really mindful of. And in this particular case, that's what he's alleging, and that directors may have paid dividends to themselves and not to other directors or not to other investors.
I'm involved with Brisbane Angels, and it's something that we often see because at that early phase, that's the riskiest phase. Now, it's one of the reasons why pref shares are a bit of a thing, because it gives some level of protection around some of the challenges that are described in this behaviour, some of the challenges described in this article. But it's not foolproof. And Brisbane Angels has a couple that effectively, in our view, became Phoenix operations, which I won't name, but they're out there where they effectively used the investor capital. They ended up winding it down. There was some conflict that happened between board members. It all gets shut down, magically starts again, but without those other shareholders. Now, the problem is the court action that's being taken here is expensive, time-consuming and challenging, and small angel groups often don't have the resources to do it. And that's why it's incredibly important that you get the share stuff right, the documentation stuff right, but understand that this game is a game of risk. And I don't want to say it's par for the course all the time, but it's just some of the things you got to take into account.
Yeah, and I think other than documenting, I think a lot of founders document the agreements. Well, actually, no, there's a lot that don't as well. But having the agreements in place is one thing, but also documenting decisions, like having minutes of meetings, making sure that you actually communicate decisions in writing after decisions are made. I think that in some ways, this is also having evidence in case something does come up. But it's amazing how retrospectively we rewrite our memories of different conversations and handshake agreements. So making sure that those types of more softer agreements or conversations or intent or plans are actually documented and shared in some way as well.
Yeah, I absolutely think that's right. And I do think sometimes there is a misunderstanding. Angel investors were originally called angel investors because not only did they put money in, they helped. And it wasn't necessarily in exchange for equity, but sometimes that is the agreement that is struck. And so that does need to be documented. So everyone's really clear about their expectations and understand what each party is seeking and has been promised out of the deal. But I think that the other thing that's important to talk about is because a lot of the things that were discussed in this article are being alleged, which is that a deal was being oppressed in board meetings, was cut out of access to information, you couldn't get access to sort of financial records and being excluded from management decisions. Part of almost all of that is dealt with in shareholders agreements and constitution. And so it is very important that if you're an investor or a founder or a CEO, you're really clear about what decisions get made by whom and who is involved in them, and be really clear what is needed for what is under the auspice of the board to decide, what needs to go to shareholders, what is a critical matter, which is what are the things that require a supermajority of shareholders to vote on, and just be really comfortable that you're okay with that. And I guess have a real understanding about what you're reading in those documents and what they mean.
Yeah, it's such a good point in terms of understanding what decisions you can make without shareholder approval, what you can't make without shareholder approval. And often we get these documents drafted and they get filed somewhere in a company register and we never actually go back and remind ourselves. And then we quickly catch ourselves out. But equally as well, the other aspect just internally in terms of delegations, like what authorities are delegated from the board to the CEO, what staff members carry what delegations for expenditure. And in the early days between co-founders, these things can be a really grey area. They're not dealt with, they're not documented until the point in time where someone does something and there's a misalignment of expectations and then conflict. So I think making sure that you set those things up at the start, make sure that you review them often, reread them, be aware of them, and document.
And I think once you've been through a few of these kind of
rodeos,
rodeos. You know what to look for when you read those agreements, right? It can often look really professional and well thought through. But once you've been through a few of these rodeos where you do need to have a hard conversation about some of these things, you start to get wise to the things that you need to look for. And so hence talking about these types of disputes, I think are really illustrative of the types of things that people need to think about. But also breakups are common, unfortunately, in this sector, whether it's founder breakups or management breakups or investors not being happy with how things are going, and documentation is really critical.
Yeah, absolutely.
Okay, Dia wrote an editorial as well this week. I think it actually dropped the day that this also dropped about his court case, but he's been a long time sort of columnist or contributor to the AFR, and he wrote a story about the Healthy Mummy acquisition by Halo Foods and wrote it up as a cautionary tale where there was no villain in the story. It was just bad timing.
It's not, nice to read one where there's not a villain.
Yeah.
Like actually speaking to markets, timing, cycles, these sort of things. It's refreshing to have some journalism or an editorial like that.
Go, Don, you're about to say something.
Yeah,
Sorry.
no, the thing with this one, it seems that there's multiple different moving parts. There was some debt, there was different earnouts, and often earnouts are put in place to incentivize the founders. And I was, in reading this article, thinking of 3 different earnout scenarios that I've been in, and I've got a perfect record, 3 for 3, of failing to achieve those earnouts.
And maybe just before you go on, just to explain for the listeners who may not be all that accustomed to M&A structures, they're usually comprised of an upfront fee that's paid, as well as structured often with an earnout, which is?
It's essentially based on performance, and there can be all sorts of different metrics around that performance. So on one of ours, my first one was revenue, and the second one was profit, and the third one was some growth metrics. What they're trying to do is de-risk a little bit to say, okay, I'll pay you this money, but unless everything you say is true comes through, we're not going to pay that full amount. And the idea is it's to get everyone in the same canoe, right? If you're in the same canoe, paddling in the same direction, what's good for you, what's good for me. The problem that often comes is entrepreneurs have a tendency to think like a week is a long time, a month is an even longer time, and in a year, I'm going to be able to build like $1 billion business. So yeah, all right, you're going to offer me X, and all I've got to do is achieve these things. And what happens is time runs away from them.
Specific case, the deal was priced at $17 million was the acquisition price, but only 2.8 of that was upfront. The rest was related to performance after the acquisition.
Yeah. And that's often a case. And I remember my first one, I think I was 23, had sold the business to a Westpac VC backed firm, and I was back in the day of checks. And I remember being in, I think, Hopgood Gadam's office where we're doing deal completion, and my upfront payment was $500,000, and I went down to the ANZ in the city. I still remember it, and this woman looks at this kid in probably skate shoes turning up with this. It was exactly $500,000, and there was like another 1.2 or something that in my mind I'd already spent, but timing didn't work out.
The other aspect of the earnout is the experience for the founder having been acquired, and now you're a high entrepreneurial energy in an environment in which you've typically lost autonomy. Now you are an employee, often inside a larger organization that has a completely different culture as well. The systems and process integration that happens as part of the acquisition often frustrates the hell out of you. And that 12 months suddenly becomes painfully long, or 24 months or 36 months. And I know a founder, she was acquired, and she got within a few months of her earnout for a very significant sum and just quit. She could not do it anymore. Walked away.
Wow. Yeah, I think it is hard. You're no longer the captain of your own ship. You're trying to do this in the backdrop of a merged entity and all the challenges that you just mentioned, Aaron. So it is no longer entirely within your control about whether you can meet those performance requirements. And I think that is part of what has happened in this particular case. I think the company that acquired Healthy Mummy took on some debt as well to fund their growth. And they did that at an interest rate of 9.75% and a covenant that required them to hold $2 million on the balance sheet, which they broke. And then the debt provider, Arrow Point, actually waived that covenant, which almost never happens. So that's amazing. And agreed to a repayment delay. Again, not something that's terribly common, but very collaborative of them to do that. But revenues just kept falling. And as a result, the business actually had to sell off Healthy Mummy in order to try and recover some funds, and sold it off for, I think it was something close to $500,000. So you can imagine being the founder, Rian, and seeing this business that she'd built from the ground up, sold it for what she thought was $17 million, only to see it be sold off for parts later on for cents in the dollar. That would have been heartbreaking, I think.
Absolutely.
Just a question on earnouts. So is that a standard clause in M&A? I understand it from the purchaser's point of view. It mitigates the integration risk. But from a founder's point of view, is there an incentive, like a premium on top of the value, on top of the evaluation? So for this scenario?
No, typically not. Typically, it's quite common, Jack, to have an earnout, but it's rare that founders agree to that because it is attracting a premium. It's usually because almost each one of the bidders who might have been involved in the M&A process required it.
Yeah.
But if a company is hot and there's lots of bidders and it's become very competitive, it's one of those things that potentially can drop off as a deal structure term in exchange for just all cash acquisition upfront. So it depends on competition and how well the company that's being acquired is performing.
Yeah. It is a good reminder in terms of deal structuring, and to get not just legal advice and accounting advice and other professional advice, but to also speak to other founders who've been through that journey, and to have really good M&A advisors around you to help structure.
Yeah, the one element where I felt like as a VC, I could absolutely help my portfolio companies was by introducing to them the right M&A advisor prior to exit. And to do that in a really structured way as well. 3-4 years into an investment, introduce them to a suite of M&A advisors that we thought would be a fit, just given the area that they play in and the stage that they play in, and introduce them to the company so that they could get to know them well ahead of when they are likely to exit. But also it gets everyone to start thinking about that as a possibility. And it's funny how until you do that, then it makes it quite real. But having the right M&A advisor can make an extraordinary difference in
huge difference
quantum of the deal that you're able to attract, the type of deal in a way that is more friendly for founders and for investors. And it just depends on who they know in the market and how well they can frame the narrative of why that acquisition makes sense for a potential buyer.
Yeah. And shout out to Interfinancial, one of our partners. I've been to a couple of their founder fireside chat events talking about recent acquisitions and Chatham House rules, so we can't share what was discussed there, but what stood out in the ones...
I thought you were going to say this is Chatham House rules, and I thought perhaps you didn't understand the concept of a podcast.
You know what I actually do most nights, Aaron?
So the events that I went to, I can't share the details, but like First World Fight Club. But no, but what came out in those conversations was how much the founders spoke about Interfinancial supporting them to identify the deal terms before they even went to market to try and find a good potential acquirer. And that taking the time to work out what does the founder want, what is the future legacy, how do they operate, what are the non-negotiables. I remember one of the founders in particular said, I don't want an acquirer that is like XYZ. And so, yeah, fantastic process when you have the right people to take you.
We caught up with a portfolio company yesterday, and they're doing really well, and it's really exciting. And the founders have been at it for almost 14 years now. And we were just talking about, do we look to sell? He doesn't really want to be CEO anymore. So maybe if we do a bigger raise and I take a different role inside the company. And the challenge can sometimes come when you raise a whole lot of capital and then cede control and take a different role that isn't what it used to be. And what happens is there can be a lot of conflict, a lot of internal challenge around that. Suddenly your baby is in the hands of others. And so my advice sometimes is that unless you really trust and understand the acquirer and what's going to happen, sometimes at very least it's best to get out for a long holiday or just get out rather than trying to live in a halfway house where you've taken a bit of money off the table, but now somebody else is totally in control and you can't do what you used to do. It's just a really tough situation to be in.
And a sidebar element of this story that is just worth mentioning is the liability of debt, right? And each to their own, everyone's got their own circumstance, but it shows the potential challenges of taking on debt in a business if you don't meet your covenants and you become slightly more vulnerable in the market for whatever reason, market conditions, your own lack of performance. It can be a company killer. And I've seen this at least 6 times over my career.
I've been it. I ended up back on my mother's couch because of it.
Yeah. And even Blue Sky was an example of that. They took on that debt and breached a covenant, and that caused a set of events that it couldn't recover from. So it is one of those decisions that often people see debt and think, oh, it's cheap money because I'm not selling equity in my business. The risks that come along with that debt can be catastrophic. And so you need to make those decisions very carefully.
One of my directors said just before we took on the debt facility and wasn't strong enough prior, but he said that just remember the problem with debt is you got to pay it back. And I was like, yeah, okay, cool, thank you. But that was the problem. And when we got into a bit of a pickle, banks don't make the decisions themselves, by the way. They appoint what's called an investigating accountant and you pay for it. So I think we paid EY $78,000 and they come in and they find all the reasons why you've got too much debt. And based on that report, the bank then pulls your facility and gives you X days to repay it. And then you've got to scramble to go and find it. So just be careful with debt. Sorry, Aaron.
No, I was basically going to have the same punchline, be careful with debt. But just in the way, other than breaching the covenant and what happens as a repercussion, but just the way it can play out in decision making. Like we tend to end up in short-term decision making when we get too close to the sun, flying too close to the sun. Yeah, I think, once you've been burnt though, geez, it scars. And like for me, I wouldn't go back near debt again.
No. And by that, we're not talking about sort of convertible notes and safe notes, that sort of thing. We're talking about genuine debt.
Yeah.
Has to be paid back on a schedule with pretty hefty interest rates. So, all right, we probably flogged that debt horse. So, other story. Literally, I just came up with that.
That's a dad joke. I'm putting that in the pocket.
It's such a dad joke.
Oh, thanks.
Threads. We talked about this, I think, last week, and there was an article this week. Actually, I can't actually remember where it was published, but it probably was the AFR, which actually passed out the number of kind of active daily users of Threads and compared it to some of the other social media platforms in Australia, and it's pretty underwhelming. Threads had 137,000 daily active users in Australia compared to Twitter's 700,000 daily active users, and this is on Android, so you can double that for iPhone. And the average session time on Threads, which is how long a user keeps the app open and continues to scroll through, was 2 minutes, whereas Twitter's was 20 minutes. And just to compare it, Instagram has 3.3 million daily active users and TikTok has more than 1 million. And TikTok users spend an average of 10 minutes in the app once they open it up, while Instagram is 4 minutes. So I just thought that was interesting. We talked last week about how Threads was the Grand Canyon where you speak out and hear nothing and then eventually hear your echo back like an hour later. But it had a great kind of start, but it's really been struggling to continue any meaningful engagement.
Threads was my new hope. I jumped in with such excitement. Actually, we all did. I actually remember the moment I saw our little WhatsApp lighting up and we all jumped into Threads and there was so much love and it was green fields of positivity, and then nothing, just crashed. The engagement dropped. And for me, it was because having to rebuild the network, like Twitter, I have an established network of followers. And
yeah, but over 12 years of use.
exactly.
Right?
And so what would have been interesting for me is had Threads somehow magically duplicated my connections over, so my contacts, that would have been, maybe if I could be selective still. But yeah, instead of having to rebuild the network again, actually being able to port over the network would have been interesting.
Yeah, I think it just shows how... Sorry, Don, go on.
I think we might be about to say the same line of how hard it is to build a new platform.
Go for it.
Yeah, and for especially early stage companies, here they had a ready-made market of really easy sign up. And I think the lesson for me is it doesn't matter how easy the thing is to sign up and how many people have gotten on there. You've really got to make that thing sticky. And that's obviously an obvious thing to say, but it's a really hard thing to actually do.
Even with the backing of Meta, right?
Yeah, totally. And for someone like me that would go back to Twitter looking for something specific from my contacts, especially around charts or data or whatever it might be, whereas there just hasn't yet been that transition. And so I think it's also a good lesson in vanity metrics that we often get pitch decks around user growth and all of that. But what we've really got to have a look for, where when I say we, it's probably more on the angel side because we don't really look at anything consumer facing, but what we're really looking for, even in B2B markets, is that comeback rate, that engagement rate, that stickiness rate. Are they going around you approach? So there's still a lot of lessons there to take out for small businesses.
I agree. And I think you can have all of the resources that Meta has, and it is still insufficient to launch something at scale and get that sort of meaningful engagement. I think Twitter, to your point, Aaron, Twitter took 12 years for me to build a network of people who shared similar interests or for whom I was interested to hear their view on things. And it's hard to replicate that from the get-go. Like that takes time and it's dependent on algorithms over time, serving you information and then seeing what you pick up on. You can select them yourself. The challenge with Threads was it tried to replicate the networks I have that were built around a visual platform, which was mostly my friends, whereas Twitter is text-based and was based around actually not my friends, really. It was all these weird and wacky people from all over the world who were saying interesting things. The kind of motivating driver or the originating driver was so different for those two different platforms. It's hard to build one on top of the other, I think.
I completely agree. The fact that Meta launched Threads, yes, they're incredibly resourced, so in terms of capital and engineering talent. Yes, they're incredibly resourced in terms of the IP of engagement through their current platforms. But I completely agree with you. The type of content and the type of network you have on there changes the engagement. And for me, my social media platforms have very distinct followers and connections. My Instagram is very different to my Facebook, which is very different to my Twitter, very different to my I think the most correlation I have actually is Twitter and LinkedIn as audience bases. And we mentioned this in one of the previous podcasts, but really seeing in what I call the demise of Twitter, at least I don't engage with it. I don't see much content, meaningful content on there or meaningful engagement. But now LinkedIn the engagement on LinkedIn has skyrocketed. And not just because we're using it actively, but I'm hearing the same feedback from others that LinkedIn engagement has now increased significantly. So it's interesting how the patterns shift. And I wonder how much the launch of Threads and people not leaving Twitter, but maybe disengaging and into Threads actually also helped with the transition then to LinkedIn. I'm curious how much that played a factor.
Oh, look, I just think text is hard.
Yeah.
If you look at I pulled a kind of social media benchmark report that was launched like earlier this year, and it has showed that the posting frequency on Facebook and Twitter have both dropped, whereas engagement per post remains steady at 0.06% and 0.035% respectively, whereas TikTok has like a post per week rate of 1.75 videos. Like moving pictures are just way more engaging for people than text. And whether that's microblogging on Twitter or Threads or whether it's Facebook, And we see this ourselves with the content marketing that Don does. Like, we get almost no engagement out of text-based stuff, but when we post videos or pictures, it gets way more engagement.
Even when they don't watch it, apparently. The number of times I hear someone say, "Oh, I'm liking the podcast. I haven't actually listened to the last one, but I really like the comments." So we're getting better text engagement just by having a video and audio element embedded, even when they don't consume it. But on that, it's interesting with TikTok and Instagram. Instagram is, I'm following my social circle and what they're doing. So it's mostly friends and family. But TikTok is consuming random strangers' short form content as a form of almost entertainment, and that addiction and the age demographic. So apparently TikTok is mostly 18 to 24. Instagram is 24 to, I think it's 35. So Jack, I'm expecting you to be like an avid TikToker.
Our resident TikTok expert.
I haven't spent much time on TikTok. But yeah, just to go back onto Twitter, and Threads, I still back Meta's play here, because conditional on it not being the expenses of building this, all it takes is Twitter to step one way, do something wrong. And when you've got a really disruptive owner, Elon Musk, now Threads is the alternative. Like, I still wouldn't put LinkedIn as the alternative here. So as long as they can continue to fund this without it leaking too much cash, which they spent so much on the metaverse play, I'm sure this is only a third of it. There's the alternative. So it's just going to take one day for Elon Musk to blow something up and everyone's got to jump across.
Don?
I'm offended that you throw the microphone to me. All I say is, Jack, I am willing to put any money on it that you want.
What, you don't think that'll happen?
Fucking oath I think it's going to happen. That's why I want to put the money on it.
I just think it's going to take time, Jack. So I think Threads will be a competitor. It just isn't really right now. But because it depends on user function and user experience, right? I think, as I've bemoaned before, I feel like what Elon did was come in and just fuck around with a platform that the users loved. And he made all these decisions and changes which had absolutely nothing to do with making the user experience better for the user, and everything to do with a whole bunch of other things that he's trying to architect in the background and navigate. Why platforms keep doing this and not focusing actually on what the customer wants or the user wants, I cannot understand that. But I think the lesson from this is do what the user is asking, and eventually they will just love you for it. And I am slowly seeing Threads continuing to add bits of functionality. It's just not a straightforward process. Like, it is hard to do that at scale, even if you're Meta, I think. But I think let's give it 6 months or 12 months and see where they're at then.
Yeah,
Totally.
I think so.
Cool. Okay. Every week, I think it's in the podcast contract, we have to talk about AI. Is that right? Yeah. Great.
Bingo.
It needs a jingle. Yeah, before we talk about AI, we need a little jingle to play.
So Capital Brief this week talked about Queensland startup, actually, I think it is, MEQ, which has raised $6 million to, I guess, further progress the platform it has for measuring meat quality using AI. And I thought this was interesting because we've seen our fair share of AI companies deal flow of late. One that we saw that was similar to this was around measuring milk quality and using AI to do that in a way that was completely independent of geography and a whole bunch of other factors. And I just think it's an interesting use case where there are a number of dynamic factors that need to be brought in to play in order to optimize, and wasn't a natural thing that you would think you would use artificial intelligence for, but is cool.
I think it's very cool. I've seen probably 3 or 4 AI and mostly really machine learning for grain quality recently. But yeah, red meat, I find this quite an interesting application. And I'm really curious about the variables in that. I'm really curious what they're measuring and how open to manipulation that might be. As in, genuinely, I don't understand exactly how this particular technology works. So I'm fascinated to learn more about it.
And I think there's huge opportunity in the AgTech space. And when you think of the VC lens of, I don't know, are we going to need more food or less food? Are we going to need to be more efficient or less efficient? It's got some really great, but there's sort of 2 things that come together for AgTech, ag and tech. And investors tend not to like the ag and the tech.
Do you mean
And
together?
that's probably
They don't
together.
Yeah.
And a lot of it is probably a lack of understanding, because a lot of ag tech is not subject to the weather or market pricing issues of ag, right? That is more the producer's challenge, and the ag tech is helping them resolve that. But there's still this legacy hangover of, who can forecast the price of this or that? Actually, if you're making, and a shout out to one of our portfolio, Swarm Farm, who's revolutionizing how sort of autonomous robotic platforms that can handle spraying and picking and slashing and all of those types of things to increase efficiency and reduce labor. That kind of product does not rely on the weather or the price of something. It's something that has to happen every day on farm. And there's still a little bit of education, I think, that has to happen in that space.
Yeah, and those not taking a couple of deals to investors from an ag tech base and chatting to them, questions come up about how easy is it to reach farmers to sell products? How easy is it what are the distribution channels? And I think it's just a lack of knowledge and awareness of how those markets operate, and actually how much infrastructure and supply chain is already in place to reach the farmers. And the other thing that we're seeing, I don't know if this is true of the world, but in Australia, we're seeing now generational change on farms. So younger generation of farmers now coming through who are looking for more innovative solutions. They're looking to adopt technology. Their own technical literacy is much higher than previous generations of farmers. So for me, I think it's a sector that Australia could really own on the global stage. I think it's a huge opportunity.
I think it's just a bias, a discrimination that investors have against old traditional industries, which this gets put in the bucket of. You look at the National Reconstruction Fund priorities, and value add technology for agriculture, fisheries, forestry is actually one of their core priorities, which something like this fits very squarely in. Why wouldn't we be doing more investment into technology that enabled the industries we already have a leading position in? I just find, for me, it feels like a no-brainer. But yeah, some people just don't like it, think it's unsexy.
Or just don't get it.
We love it. Just, don't get it. But also, do they get quantum computing? Probably not, but they're still investing in that. So
very true.
Anyway, while we're talking about quantum computing, actually, the other thing that came out last week on Friday was the top 100 innovators list, which has now become an annual thing in the Australian. David Swan and his team. I love reading it. It's super easy to read. It's very quick, clear summaries of what these amazing companies are doing. And it's just wonderful to see the sort of broad brush of innovation that's happening in Australia, and to do it in a yearly manner. You can see how things are evolving.
Yeah, I love it. And I love that they acknowledge not just the founders, but also some of the innovation ecosystem enablers and others. So it's good to see some friends and faces get up there that we know. And collectively, I think we've each worked with these founders before, or different ecosystem leaders. For me, a couple of shout outs on the list were like David Burke from UNSW, Haymarket HQ with their focus on the Southeast Asian market. But for me, Rainstick, so Daryl and Mike made the list. And so they're actually using a technique from Indigenous communities, which involves like harnessing lightning to get better production yields of mushrooms, of all things. So they're using the technique, I did look it up, to basically grow mushrooms faster. But two awesome little humans that are just building a great startup.
That's great. You want to make sure you're growing the right mushrooms, though, as we've recently.
There's been all sorts of other headlines about that, but yeah.
There's the right mushrooms, and then there's the right mushrooms. But anyway,
that's very true. Yeah, there were some standouts for me as well. One was Lexa, which was a company I led the first investment in, which is led by Dave Whittle and has a range of products for enterprise to use to understand and interpret data insights from social media listening. And so it's still one of my favorite investments. And so I'm so pleased to see that they're going from strength to strength. The work that I've been doing with the ANU over the last 3 years, there were like 4 companies that were spin-outs that I've shepherded out of the ANU, which made it onto that list. Quantum Brilliance, which is developing a room temperature quantum computer. Nomad Atomics, Samsara Echo, which Samsara is technology is amazing. Just trying to take any bit of plastic and return it back to its principal monomer, which means that you never have to create any more plastic ever. We have enough plastic in the world. If we can break it down to its original monomer, we can recycle it and reuse it infinitely. So that's just an amazing company. Sienta, which was spun out by Yekaterina and Luke, which is amazing 3D printing technology. So ANU's got a really progressive approach to spinning out technology. So it was great to see a number of those companies profiled.
And there were some others on the list. So a mutual friend of ours, Annie Lou from Fingerprint for Success. And so Michelle was Creel Price's coach. And when Annie Lou and I met in South Africa, we went there on a trip.
This was the Steve Irwin moment we talked about last week. The Steve Irwin moment that you talked about last week.
Yes, that moment may or may
Refer
not
back
be on the
to last episode to get that story, guys.
Yeah, but Creel, because I remember talking. He said because Creel, I think, sold their business with his business partner for 110 million, and he was talking with Michelle at one point, and Michelle had just asked what was the value of the coaching, and Creel had just said, I think at the end of the day you got us 70 or 80% better with the coaching. She said, oh, so I made you 70 or 80 million. And he went, yeah, okay, maybe that's right. And from there, Michelle has taken those things and tried to systemize and make them far more open source through what they're doing there.
It's a really fantastic platform, actually. And we'll be speaking with Michelle next week, so I'm looking forward to that. The other thing I liked about the list is there was real diversity in that list. So not just gender diversity, but all manner of diversity. And I liked that they acknowledged, as you said, Aaron, the kind of engines and the enablers that sit behind it, not just the kind of companies that have been created that are doing really innovative things. I think you talked about David Burke, UNSW, and I think they profiled StartMate as well. And so that was really great to see because they often are unacknowledged, important parts of that whole supply chain.
Yeah, absolutely. And they're also innovating the way that we support innovation. So, I really love that they included them in the list.
And Eti was also featured. So the pleasing thing for me was to see that we have a government that is back on the side of innovation and has made it a priority in their policy and budgetary kind of allocations as well. So that was awesome to see. There was an interesting article that Bronwyn Clune in Capital Brief published this week, which was a Q&A with Maxine Minter. And the kind of headline was that it's Australia's first female solo GP. So I found the interview fascinating and for a whole bunch of reasons, but it did make me think, is she Australia's first solo female GP or is she Australia's first solo GP?
I wondered this. The only person that came to mind, Roland Grant with Full Circle VC. I don't know if he's solo.
He on his own. Okay,
maybe.
Right. I thought he did that with Dan.
Possibly.
Yeah, I'm fairly sure there's a few GPs in.
Yeah, because it's not a common thing, right? It is part of what the article is focusing on was that it wasn't common, and that she was the first. She saw that as an opportunity in Australia because her experience in the US is that there were far more solo GPs, but it isn't that common because it's really hard. I have a friend in New York, Charlie O'Donnell. Shout out to Charlie. He was the solo GP of Brooklyn VC. And he used to be with Union Square Ventures before he set up his own fund and he was solo GP. And I just remember talking to him going, I don't know how you do that. And there's so much to do. How do you cover it all yourself? And his comment was, I just do it because I don't really want anyone else to make a decision. I just want to have kind of the full control over the process. And so for him, that trade-off was what was important. But he wrote a blog in May this year after doing it for 20 years. Like he has actually now decided not to do it because he's just had a little kid. He's married. His daughter is the cutest thing you have ever seen. And he's just like, my lifestyle does not support being a venture capitalist, let alone a solo GP. So I thought that was extremely brave for Maxine to take that on. But comments?
I think our very first episode was really around the co-foundership and one of the challenges. I don't think it's whether it's solo GP or solo anything. it's just a bit of a challenge. And the question becomes, is if you are going to go down that solo path because you're seeking those trade-offs, is how do you assemble that team below you that still has all the same energy and passion and long hours and deal with the pain and the shit that inevitably comes. And if you can do that, probably all right. But statistically, it's just difficult sometimes.
Yeah, I'd be fascinated, given there might only be a couple of solo GPs in the world, it sounds like. But I would be fascinated to see the data of correlation of team size and number of GPs to fund performance, for example. And interested around like the LPs making decisions with a solo GP. Like, I don't know how you would manage it. There's our team here, and I feel there's a lot to be done.
And I think sometimes it's not a function of wanting control, right? So I think what Maxine was trying to say in that article was it was a function of the size of the capital that she's running and managing. It doesn't have a fee level that supports a bigger team than just her. So it is just her. And that she even has to have this portfolio approach of a career in order to do that. Like, she still needs to do other things that pay her a salary so that she can do this as well. So I think part of it is a function of size and scale, but also, wow, good on her. That was, I was like, I'm so pleased to see it. And what I think it's a super brave and courageous thing to do. So good on her.
Absolutely.
She had an answer to what's the best piece of advice anyone's ever given you. And she said, never underestimate the profound impact of compound interest over time. It applies not just to finance, but to relationship skills and the incremental progress that leads to monumental growth.
Absolutely. I loved that line too.
I am
Last week in that episode,
Okay.
Well, I was saying that in my school talk that I put the students to sleep on, I think it may have been the point where I had the exponential graph, and maybe at that age they aren't yet ready to think about the compound interest of thinking. But I totally agree with it's so important.
Last article that we might just finish on was not an article, but a report that was, I guess, launched this week, John, that you found, which was on the kind of SaaS industry. And I know we've talked about this previously, and we'll put the report in the show notes. But I thought this was a really interesting report because that's my dog trying to get in through the fly screen. He's not happy. Great. That's 75 kilos of dog trying to get through a fly screen. There were some really interesting kind of summaries in this report, which I thought are probably worth touching on, because I think it's a good way that portfolio companies or SaaS companies in the industry can triage where they might want to focus their energy. Firstly, best-in-class growth. So this was an evaluation or an analysis of the companies in the market and kind of compared them in stage. Best-in-class growth is doubling ARR per annum. Top decile is 192% growth per annum for companies that are doing between $1 and $3 million of ARR. And of course, the growth rate is dependent on the size, but the median is about 30% per annum. So average SaaS companies are seeing about 30% a year-on-year growth. Best in class is 100, but the top decile is 192. I thought that was really interesting. Only 13% of SaaS companies ever get to the 10 million ARR milestone.
I was quite surprised by that. And I assume that's starting from, like, where's the measuring?
Well, they said even after 10 years in existence, only 13% of SaaS startups get to 10 million in ARR.
Wow. So hats off to those that do. And we have one portfolio company that's getting close. Like, that's quite an achievement given the stats.
Yeah, it's that sort of vague milestone that everyone talks about, because it's once you get to it, you can raise larger amounts of capital at a larger valuation because you've met this sort of status that it's a line in the sand. There's no particular science behind that. But the fact that only 13% of startups actually get to that level is, if you are close to that, then you're doing pretty well. The other was that the majority of SaaS startups prior to 10 million in ARR grow their revenue by growing their subscriber base, not by growing their revenue per customer. That's the majority, where the majority of their growth comes, which kind of says to me that product-led growth is nice, but it's not what's moving the dial for their growth at that early stage. And that the other lever that is highly underrated is net retention growth. So SaaS businesses with a net retention rate of over 100% grew on average by 54% year on year, whereas companies that had a net retention rate of 60 to 80% only grew 21% year on year. Now, it's obvious. If you do the math of that, it is obvious. But in terms of understanding, okay, where could we actually spend some time and really try and move the dial on a particular metric? Net retention rate might be one of those really easy, low-hanging fruit. It's not easy to do, but it's a low-hanging fruit that you could think about, which could really supercharge growth. Following on from that, then the higher the ARR, the higher the proportion of revenue that comes from expansion rather than new customers or new subscribers. 30% of revenue for companies that were between 15 and 30 million in ARR was coming from expansion revenue rather than new subscriber. And that reactivation was the real low-hanging fruit. The top quartile of SaaS companies are able to reactivate a quarter of lost customers.
Wow.
So this ties into churn, obviously. But if you've spent a whole bunch of money already on acquiring those customers. Yes, you've lost them. Spending a bit of time and attention and maybe a bit more money on reactivating those lost customers seems to be a real correlator with success.
Yeah, it's fascinating data. And to your point, these underrated or often not looked at aspects of how you could actually grow. It makes me think of Don, the portfolio company we caught up with yesterday, who was sharing that one of the things they would have liked back at an earlier funding round is for their investors to actually sit down with them and give them the understanding of the metrics that they should be measuring. And I think just hearing you go through these numbers again, this plays out in my mind, like actually helping founders, and actually back to the engagement topic around threads and what are the meaningful metrics we should measure. I think helping more founders to understand these other metrics and these other areas that we can focus on to help build growth is really valuable.
And what he was saying is quite right. For us, we have to use these metrics when evaluating businesses to work out where they are in the map and help our investors make their decisions. And then from the founder's point of view, there's the saying, what you can't manage, what you can't measure, and what gets measured gets done. And by at least starting early to understand some of these metrics, then it just helps start focus some business decisions, as long as you've got the right vision and mission and making those decisions for the right reason and not become a dashboard driven company. But what was really interesting, this company has been around for 14 years, and last year they were getting hammered on growth because their growth rate, as they got bigger and older, is coming down a little bit. But their retention is unbelievable. Like it's 120 something %.
Again, though, that's entirely normal.
Yeah, no, totally. It is normal. And having some data like this can then help better explain that. But this year, people are less intrigued about, it's not that growth is irrelevant, but what's getting them a lot of focus is their retention. And their retention, because of their ability to scale up and scale down and actually produce cash now, suddenly they're far more interesting and of value to some of the larger investors, because they've got, in a market that is pivoted from growth at all costs, their business as a healthy grower is now raising up the flagpole.
I agree. I think it's how you can not only just benchmark yourself against your peers, but you can do it in a way that is life cycle weighted as well. But I think it's a good health check to look at what your numbers look like there. So you can say, actually, that's some low hanging fruit or some really easy to address areas that we can focus on for a very specific period of time and see if we can move the needle on it and make that decision about trade-off for growth versus profitability. The great thing about SaaS is you've got so many levers that you can pull there.
So I'm going to put this one in the show notes, obviously. Plus, a few episodes we've spoken about the Open View Partners one as well, which is really important. And the key there is start looking at the metrics that are important to you. And from an investor point of view, make sure you're benchmarking these deals and can see where they are in that life cycle.
Great. That's the weekly news wrap up. Again, lots to talk about, but really interesting topics, I think, which hopefully is of use to our listeners, maybe our 7 listeners now this week.
Double digits.
The same temperature as Adelaide, 11.
Guys, what are we looking forward to or excited about at the moment?
For me, I get my kids next week for the school holidays, so taking them away to Cairns, so that'll be nice. It also means a bit of extra support so I can still get work done, but no, looking forward to that.
Awesome. Sounds like it might be hot there.
Just the humidity. The humidity is going to be tough.
Jack?
Same answer as last week. Games are getting better. As the tournament gets closer towards finals time, we're just getting better games. So,
if you haven't listened before, he's referring to rugby.
Yeah. So I'm up Sunday morning, 4:30, watching a game, and then Monday morning, 4:30 as well. So the time zone's not great, but can't miss them.
Are you getting ready for kids, Jack?
No.
Early start. Just getting the practice. Well, I've been at the farm actually, and I think maybe now that I think about it, the reason the internet was so poor is that my brother-in-law's hijacked the projector and the screen and put on. I think the Wallabies lost to Fiji. Jack, was
that was a shocker. But we got redemption this week against Wales, so fingers crossed.
And then I equalised by forcing the family to watch Barbie, the movie, around the campfire. But with a half an hour to go, I was the lone person by myself watching it, which
the others
was actually one of it.
Didn't like it? You're bored?
My mother, I have to unpack with.
What did you do?
I think it's a generational thing. My sister-in-law, who really likes it, had already seen it, and then she got tired. And then the problems with the cousins and the
little ones
and whatever else. And then the brother-in-laws, they're like, what happened to karaoke night of drinking and ACD and whatever else? How has this been hijacked? But my farm, my rules.
Fair enough. Yeah. So me, I'm not excited about anything in the personal capacity, but in professional capacity, and we can edit this out if you guys don't want to put it in, but I'm really excited about our fundraising. So we formally launched fundraising for our captured fund, and I'm super excited about that. It's going to be a process. Yeah, but it's the right time. We think it's just so exciting in the market at the moment. Things are turning, as we talked about in this podcast episode. The B2B space where we're playing is just really thriving in Australia. We feel like we're doing something that's a bit different, and it's just got me super pumped. So
super pumped.
Exciting.
Super pumped. Yeah, that was ominous. I shouldn't use that term, should I?
I was just about to say, but like a healthier, nicer ending for the shareholders kind of
I'm very excited.
Yeah. No, as we all are.
It's also tomorrow in the calendar's Tribe's.
Oh, yes, tomorrow is Tribe's birthday. Second birthday.
Yeah.
On the 22nd.
Right. Yeah. God, we've already gone to, we don't care how old we are. Like,
genuinely, 2 years has just flown by. Far out.
And so will the next 20. So I look forward to that.
And on that note.
Well, my internet has just shit itself. I didn't hear any of that. Can you say that again? What was just said?
That it's Tribe's birthday tomorrow. And I said I look forward to the next 20 years going by really quick, but funnier.
I was 27 2 years ago.
My God. Yeah, actually, that's true. I've aged. Actually, it was probably the 3 years before that. I swear I aged 10. Oh.
Well, thank you for enduring this. I did write a little blog today called Sitting in Discomfort.
And what was this your this is me.
It may be for the listener.
I thought it was a description of sitting on a podcast with us.
Yeah, in preparation for another podcast, I wrote an article of how I've got to sit in my discomfort.
No, the listener, to prepare them and train them for enduring. Thanks, gentlemen. Same bat time, same bat channel next week.
See you then.